Making sure your association's financial statement presents well can be challenging in the best of times, but doing so in the COVID-19 era adds a layer of complexity. So can you point out some areas that need special attention?
I'd love to discuss that, and I wanted to thank you for having me here, Carol. So we wanted to talk about the restricted cash portion that we a lot of times reflect on our financial statements. So you are right. Financial statements can be challenging to look at. A lot of buildings don't like to look at them because they think it's complex. At Czarnowski Beer, we really try our best, and I think it's one of the things that helps us stand out in the industry is to make sure that these financial statements, which could look arduous and complex, are clear and explainable to the common shareholder or unit owner in co-ops and condos. So so the one thing I wanted to talk about, or the couple of areas I wanted to point out, was firstly restricted cash, like I was talking about. Cash, right? Money comes in to the buildings, and it's always the biggest question: where is it going? Where is it being spent? And the example I always like to present to my staff is looking at it with a piggy bank theory. You have a couple piggy banks. You have a piggy bank that your grandparents are giving you money every time they come over. You drop a little money in that piggy bank. You have a piggy bank from your parents, and you allocate those piggy banks. Grandpa and grandma's piggy bank is going to be for the bike I want to buy. Maybe mom and dad's is going to be for the video games I want to buy. And you continue to build up funds. Hopefully you don't need to tap into them for other reasons. And the same thing is with co-ops and condos. You have your operating account, which you're using to pay your bills. But your reserve accounts are really where there's a lot of emphasis and scrutiny put into them from the boards, from potential buyers, and making sure that you have enough reserves, and what are they for? So one of the things we do, and as part of the audit and trying to make sure it's explainable to the boards and to shareholders, is what are the funds for, and are they being used correctly? And one of the things that gets put into piggy banks at a co-op or a condo would be assessments. And a lot of times those assessments are done either for specific projects, they're done to build up reserves for future projects. And one of the jobs we do as part of when we audit financial statements is to make sure that if they're collecting money specifically for a purpose, it's set aside for that purpose. Many of times we'll find that when we're looking at a building, we're auditing them at year end, or even doing an interim review of their financial statements, they're putting away money, every month. Money comes in from the assessment, 100,000, they sweep it over to the reserve account. Then all of a sudden we see, oh, they needed some money to pay from utility bills. Oh, they need some money to pay for some legal bills that came up. The money came up for something else, and the money's going out, but it's not going out to what it's for.
So let me just ask you. So in this era, if I raised funds last year for a roof project, and now we are noticing some cash challenges because some of our shareholders can't pay their maintenance or are paying late, and I know I have $500,000 that I have raised for my roof project, and I use some of that $500,000 for my operating fund, is that I guess I've used restricted cash, and so what's the big deal with that?
So it's a great question. I mean, the big deal with it depends as to how the money got there. So if some buildings just have some extra money, they throw it in there every month, and they just build up a reserve account, and there's no rhyme or reason to it other than the fact that they're just being frugal with the money they have, and they're building it up, and over 10 years they have 500,000, which is great. Then there's no rhyme or reason. That's what you had it there for. We call it a rainy day reserve account because it's a rainy day. Unfortunately, right now that's going to be used by a lot of buildings. But if you were collecting money, let's say you wanted to do a lobby project, or let's say if you said a roof project, I believe, next year, and you're starting to collect funds for that money is really classified as a contribution to the building. So that's a capital contribution that is not part of your operating budget. some buildings will allocate that as not as revenue specifically for tax purposes, and also on the financial statements. So now that you're allocating money that you were using for capital contributions, now using them for operations could pose an issue, because what did you tell your shareholders or unit owners? Hi, we're imposing an assessment to use for the roof project. So they're taking the assumption that these are contributions that they could add to the basis of their homes when they sell, and they're getting a capital contribution. The building's also not picking it up as revenue on their tax returns potentially. And now you're switching it to operations. So now you get it into whether or not, do you have to tell the unit owners? Do you not? I assume you do have to tell the unit owners, obviously. And do what's going to be with all their contributions over the years? If this has been an ongoing assessment for years on end, how do you deal with that? One of the ways could be, okay, we're taking accounting of how much we're taking out of it, and then we plan on replenishing it in the next year, which would be the best approach. The other approach is, discussing with your accountant and counsel as to how you should go about this legally, to see how do you disseminate the information to your shareholders and owners about, now that you switch the focus of the funds from capital to operations.
So bottom line though, if a board taps into funds that were raised for a specific project and decides to use it for operations, they're going to probably have to notify shareholders of that, who may make adjustments on their own personal tax returns.
Yeah, if they're selling that year and they normally would have taken those contributions, and let's say in a co-op on a per share basis, and a co-op and a condo on a percentage of common ownership, they would have to reconsider that for the whatever happened that year. So let's say, like in your example, if it was 500,000 and that was based on a 500,000 assessment that they paid in the year before, that they would have to allocate out whatever they contributed from that. So,
and let me just ask you, so for this year, let's say that a group of my shareholders had difficulty paying their maintenance. They lost their jobs. And now it comes the fall and we're preparing our budget for next year. Or maybe it's even last year people hadn't paid their maintenance and I've prepared a budget. I guess my question is, for those uncollected funds, how does that appear in the financial statement, and how do I account for it in my budgeting? And will it be a surprise in my budgeting?
So it's a great question, and this is, as you mentioned, this is something that not only is applicable and pertinent now with everything going on, but in general, I find a lot of times, or we try to advise our clients that when it comes to budgets and it comes to units that are in arrears, that have receivables, how it's affecting their budget isn't always taken into account. So, for example, let's say now in 2020, where a budget was prepared, assuming everyone was going to pay, which is usually what most buildings do. You assume everyone's going to pay their maintenance and their common charges. Now in June, you have a couple of units that lost their jobs, they can't pay, or sometimes you have estates that people pass away and now they're not collecting the money. You're not getting that money. That money's not coming in. On a bigger building, it might be less of an effect because you're dividing that amongst 350 units, but in a smaller building, that could be a significant amount of revenue that the building's relying upon. Now you go into year end, you get into the fall, you're doing your budget. A lot of buildings will kind of, I don't want to say ignore what is happening in the current year, but they'll say, okay, let's prepare our 2021 budget and assume we're going to collect all of that revenue. Okay, but that's assuming that the problem was resolved by January 1 of 2021. But if the same owners are still not paying, number one, you have to kind of make up for, let's say if it was June, 6 months of non-payment. So now you don't have that 6 months to pay for. And now you have a continuous issue that's going into 2021 that you need to take into account. So on the financial statements, to answer your first question, that'll be reflected as a receivable. And in your monthly management reports, it'll be reflected there as a receivable due from those owners. But when it comes to the budget, which I think is the important thing that people kind of miss, is you didn't get the money. So the money is still missing, and how are you going to make up for it? You might say, all right, I'll pull it out of reserves. That's one plan. Another plan might be, oh no, I expect to get this money next year because the individual passed away, the estate is selling it, and when we sell it, we'll collect the receivables. That's also a very reasonable, explanation or resolve. But what if you're not going to get it? What if the person is, he has a mortgage on his unit, and you're not, if it's a condo, you might not be first in line to get money after they foreclose. You have to seriously take into consideration how you're going to make up those receivables, or reflect in the budget that, yes, I expect to get revenue of, $1 million, but I know 20,000 of it isn't coming in because this person is not paying. And how you resolve with that, either you do, a plug assessment just to get you through that time, increase maintenance, which may or may not be the right way to do it because it should be a non-recurring item. Those are the things that boards sometimes really should be looking at, and it's something we try to push when boards ask us to review budgets, and we're looking at budgets in the fall that are applicable to those audits. We'll reach out and say, hey, how are you dealing with this? It looks like you're not getting this money, and what's your plan?
So I guess the plan, let's assume you didn't get $20,000 or $30,000 this year. In your budget next year, you probably need to increase your revenue by whatever that missing component was if you're actually going to create a budget that's in balance.
Correct. It's right. It's you have to account for, because most budgets are prepared break even. So you have $1 million of revenue coming in to pay for $1 million of expenses. So if you're not getting $20,000 of revenue, either you hope and pray that you have an expense category that's down 20, which happens, it fluctuates, or you take money out of reserves because that's where you're going to get the money from to pay the bills. Or you don't pay the bills, which is another option, which buildings do, is they don't have the cash, so they don't pay, or they don't want to take money out of reserves. Or you account for it in the next budget and say, we have, if it's a small building, we have 3 units not paying, that's half of our budget, and we need to assess everybody else for it. It's unfortunate. The other option, which again is not my favorite, if you have a line of credit, if you need to, lines of credit, usually are set aside for emergency capital projects to finance those things. But in times like this, or if buildings don't have the operational revenue, or they don't have the unit owners or the shareholders that can afford to pay an assessment, they might tap into the line of credit to pay for bills, and that's another option as well.
So I guess bottom line is, for boards, and particularly board treasurers, you really have to kind of take a stock of what's happening now, so you can look forward to 2021 and what's going to happen with your budget and ultimately your financial statement.
Correct, and that goes on both sides. You were talking about receivables, but also with bills, because I think one of the big things that's going to come out of this, and in general, when you don't have enough revenue, you stop paying bills, like I mentioned. So you're going to have an increase in liabilities. Your accounts payable is going to go up. When it comes to unpaid bills, so the other thing, so the other gap, it's the same way we have with a gap with receivables that are not accounted for. I'll have a building go into the new budget year and say, oh, I'm budgeting $70,000 for professional fees. But you ask them, well, don't you have another 70 from last year that you didn't pay? How is that being paid? And a lot of times that, it becomes a snowball effect where now you were over budget on expenses. You didn't have the revenue to cover it. Either you didn't pay the bills, or you paid the bills out of reserves. How are you, going into the new year? A lot of times everyone looks, all right, let's start from January 1. I want to start fresh, look out, but you have stuff that's here and that hasn't been dealt with, hasn't been paid. And how are you going to deal with it? And I think when it comes to that, people, a lot of times we try not to advise people to do this, boards, but a lot of times assessments are put into place in lieu of increases, right? They don't want to keep maintenance down, they want to keep common charges down, so they'll do an assessment. But that's a special assessment's only there if there's something special, right? You had legal bills, you had a leak, you have you have a gas leak, you had something else that came up that was a special item. Sometimes buildings, they have, if they're dual fuel systems, they had to go onto fuel because it was really cold and they didn't budget for such a cold winter. You do a fuel surcharge or a fuel assessment. That gets you over the hump because you don't expect that to happen again next year. So a lot of the buildings might be looking at this year, because they have to defer payments for other expenses that they can't pay because the revenue is not coming in, to do a special assessment specifically for this reason. If someone's, if you're behind on your bills because people aren't paying maintenance because of the situation with COVID going on around us, to do a special assessment to get there would not be the wrong thing to do, especially if you're telling shareholders that they don't have to pay their maintenance. So that's something to look into when you're doing your current budget, because we're only, right now we're only in April. So you want to look at it, when you get to June or July of any year. I always tell our boards to look at your budgets throughout the year. You're getting them every month in your management reports. See how you're doing. If things are not going in the right direction, you need to act now. Otherwise, you'll get to October, November, and you're not going to be able to pay your real estate taxes. You're not going to be able to pay your utility bills, and you're going to ask yourself what happened. And
Right.
you want to kind of look at it in time. So we try our best when we're doing our audit, because we look at the audit a couple times a year, in different stages, to call our clients, say, hey, do you realize you're over budget in this category? What are you doing about it? Stuff like that.
Okay, thank you very much. Wise words for all board treasurers.
Thank you very much for having me.